You want to learn trading. You open up the charts, ready to start. But then your brain just hits pause. Red, green, long wicks. You zoom in, you zoom out. But nothing makes sense. Your brain feels hijacked, overloaded, and confused. The candles might as well be hieroglyphics. But here's the thing. You're not dumb. You're just missing the core candlestick patterns that actually matter. In this video, I'll break down all the key candlestick patterns you need to know. Simple, straightforward, no fluff. By the end, you won't just look at candles. You'll read them like a trader. But before we start, what even is a candlestick? A candlestick shows the price movement of an asset for a specific time period. 1 minute, 1 hour, 1 day, whatever your chart is set to. There are two types of candlesticks. Green, bullish candles show price closed higher than it opened. Buyers were in control. Red, bearish candles show price closed lower. Sellers dominated. Each candlestick has 4 key parts. Open, where the price started. Close, where it ended. High, the highest price during that time. Low, the lowest price during that time. The body is the thick part between the open and close. For red, candlestick opening price is at top of the body and closing price is at the bottom of the body. The wicks, also called shadows, are the thin lines that show the high and low. Long body equals strong move. Long wick equals rejection. Tiny body equals indecision. Got that? Let's move on to the actual patterns. First up, we have the hammer, seen after a price drop. It has a small body at the top and a long lower wick. Sellers pushed prices down, but buyers fought back, closing near the open. This suggests a possible trend reversal. The longer the wick, the stronger the signal. Let's look at an example on the chart. During a bearish trend, 2 big red candles appear, causing a sharp drop in price. These candles cover a large price gap. After that, the selling pressure weakens and smaller red candles form, showing that new sellers are not entering the market. As sellers lose strength, buyers start entering. This creates a hammer candle, which signals that buyers are trying to push the price up. Sellers try to bring the price down again, but buying pressure increases and the price starts to reverse upward. Wait for confirmation before acting. Inverted hammer. The inverted hammer appears after a downtrend. It has a small body at the bottom and a long upper wick. Buyers tried pushing prices up, but sellers pulled it back down. It hints at a potential bottom, showing buyers are testing the market. Confirm with a strong green candle. Enter above its high, stop below the inverted hammer's low. It's stronger near a support level or with high volume. This pattern suggests selling pressure might be fading, but it's not a sure thing. Always check the next candle for direction. Up next, the hanging man, found after a price rise. It looks like a hammer, small body, long lower wick, but signals trouble. Sellers pushed prices down, and though buyers recovered, it shows weakness. A red candle or gap down confirms the reversal. Enter below the hanging man's low, stop above its high. Check for resistance or high volume for reliability. This pattern warns that buyers might be losing strength, and sellers could take over. Don't trade it alone. Watch the next candle to see if the uptrend is fading. Next up, the doji, where open and close prices are nearly the same, with wicks on both sides. It shows buyers and sellers are evenly matched, creating indecision. It can signal a pause, reversal, or breakout, depending on where it forms. The dragonfly doji. It has a long lower wick, with open, high, and close near the top. After a downtrend, it shows sellers pushed prices down, but buyers took control, closing strong. It suggests a bullish reversal, especially near support. Confirm with a green candle. Enter above its high. Stop below the low. Higher volume or support levels make it stronger. This pattern shows buyers are fighting back hard. Wait for the next candle to confirm the trend is flipping upward. Gravestone doji. The gravestone doji has a long upper wick, with open, low, and close near the bottom. After an uptrend, buyers pushed prices up, but sellers crushed it back down. It hints at a bearish reversal, especially near resistance. Confirm with a red candle. Enter below the low, stop above the high. Volume or resistance adds strength. This pattern warns that buyers are losing power and sellers are stepping in. Don't trade it alone. Check the next candle in market context to confirm a downturn. Next up, we have the spinning top, with a small body and long wicks on both ends. It shows indecision. Buyers and sellers fought, but neither won. It often appears during market pauses or consolidation. After a strong trend, it can warn of a slowdown or reversal. Don't trade it alone. Wait for the next candle to show direction. Enter based on the breakout, with stops outside the spinning tops range. It's a neutral pattern, but hints at a possible trend change. Up next, the Maribozu, a candle with no wicks, just a solid body. A bullish Maribozu opens at the low, closes at the high, showing buyer control. A bearish one does the opposite. It signals strong momentum, often at trend starts or breakouts. Confirm with volume and the next candles. Enter in the candle's direction. Stop outside its range. It's powerful but can overextend. This pattern shows one side dominating, but follow-through is key to trust it. Pin bar. The pin bar has a small body and a long wick, showing price rejection. A long lower wick, bullish, means buyers held the low. A long upper wick, bearish, means sellers blocked highs. It's strong near support or resistance, hinting at reversal. Confirm with volume or the next candle. Enter beyond the body, above for bullish, below for bearish. Stop past the wick. This pattern highlights a turning point. Next up, the bullish engulfing, a 2-candle pattern. A small red candle shows weak selling, then a big green candle swallows it, signaling buyers taking charge. It's strong after a downtrend, especially near support. Confirm with volume or a resistance break. Enter above the green candle's high, stop below its low. It shows a shift to bullish momentum. The bigger the green candle, the better. Pair with support for reliability. This pattern means buyers are overpowering sellers but confirm before trading. Bearish engulfing. The bearish engulfing starts with a small green candle, then a big red candle engulfs it. It shows sellers overwhelming buyers after an uptrend, often near resistance. The larger the red candle, the stronger the signal. Enter below the red candle's low, stop above its high. It warns buyers are weakening. This pattern suggests a trend flip to bearish, but wait for confirmation to avoid false signals. Piercing line, a 2-candle bullish pattern. A strong red candle in a downtrend is followed by a green candle that gaps down but closes above the red's midpoint. It shows buyers fighting back, hinting at a reversal. Confirm with a green candle or volume. Enter above the green's high, stop below its low. It's stronger near support. This pattern suggests the downtrend is losing steam, but it's less decisive than engulfing. Up next, the tweezer top, a 2-candle bearish pattern after an uptrend. 2 candles, often green then red, have similar highs, showing buyers failed to break resistance twice. The shift to selling suggests a reversal. Confirm with a break below the second candle or volume. Enter below the red's low, stop above the highs. It's reliable near resistance. This pattern shows buyers are tiring and sellers may take over. Check for overbought signals to strengthen the case. 16. Tweezer bottom. The tweezer bottom forms after a downtrend. 2 candles, usually red then green, share similar lows, showing sellers failed to break support twice. Buyers stepping in signal a possible reversal. Confirm with volume or a break above the green candle. Enter above its high, stop below the lows. It's stronger near support. This pattern suggests sellers are weakening and a bottom may form. Use with bullish signals for accuracy. Next up, the morning star, a 3-candle bullish pattern. A big red candle, a small indecision candle, doji or spinning top, and a strong green candle closing into the first range. It shows buyers taking control after a downtrend. Confirm with volume or a trendline break. Enter above the green's high, stop below the middle candle. It's strong near support. This pattern signals a shift to bullish momentum. The bigger the green candle, the better. Evening star. The evening star, a 3-candle bearish pattern, starts with a strong green candle, then a small indecision candle, followed by a big red candle closing into the first range. It signals sellers taking over after an uptrend, often near resistance. Confirm with volume or a red candle. Enter below the red's low, stop above the middle candle. The larger the red candle, the stronger the signal. This pattern warns of fading bullish momentum. 3 white soldiers, 3 green candles with higher closes and small wicks. It shows strong buying after a downtrend or consolidation, signaling a bullish reversal or continuation. Confirm with volume or support. Enter above the 3rd candle, stop below its low. Be cautious after a big rally, it may overextend. This pattern shows buyers in full control. It's a confident signal but needs follow-through to confirm. And last, 3 black crows, 3 red candles with lower closes and small wicks. It shows strong selling after an uptrend, signaling a bearish reversal. Confirm with volume or resistance. Enter below the 3rd candle's low, stop above its high. If too extended, it may hit support soon. This pattern shows sellers dominating. Pair with resistance or bearish signals for reliability. It warns of a trend flip but confirm before trading. And that's a wrap on the candlestick patterns every trader should know. You don't need to memorize them all overnight. Just start recognizing them on your charts one at a time. Combine them with price action, support and resistance, and a bit of patience, and you're already ahead of 90% of new traders. If this helped, hit that like button so the algo knows you're serious. Subscribe for more simplified trading breakdowns. No fluff, just facts. Until next time.